Well, our analysts take a look at their stars ratings pretty much every day based on whatever news that they do get. But I would tend to say that because our outlook is 12 months rather than 12 days or 12 weeks, there's not as much change as you might expect. Certainly, we are looking at the fact that there has been a definite shift from growth into value, especially from pure growth into pure value. Doing a relative strength chart, the pure growth is now
Right.
below the 200-day average. So the question is, how long will this last?
Have the Mag 7 broken trend?
Mag 7 has broken trend. There is weakness in this category. Tech is down almost 4% since the most recent high on October 29th, when tech was trading at a 73% premium to its average 20-year forward PE.
Sam, we just kind of getting through earnings here. Pretty solid third quarter numbers across the board here. Are they enough to support this market going forward?
Well, when you think we're going to get about 7% earnings growth, according to S&P Capital IQ, but you end up with 14.5%, that is a pretty nice gift. Also, fourth quarter estimates are now at 6.5% versus the 6% at the end of September. So when you see numbers like near 13% growth now expected for 26 and 14 plus percent or 27, I think
Right.
investors believe that we will be seeing improving earnings to help keep down the concerns about
Paul,
valuations.
that was absolutely brilliant. The summary there of
Yep.
a repeat of double digit. Sam, how unusual is it to have 13% earnings growth?
It is pretty unusual. The average is about 8% earnings growth from memory on a quarterly, year-over-year basis for quarters going back over the last 64 quarters or so. And actually, just another example of companies doing a great job of managing expectations, because in 64 of the last 66 quarters, we have seen actual results exceed end of quarter
I'm
estimates.
shocked.
Sam, for year-end 2026, we can start thinking about that now. What's your S&P 500 target, and what drives it?
Well, I think we're looking at something like 7,400 on the S&P. That's based on the assumption that we close this year around 7,000. That represents about a 6% price appreciation, and I think it's less than expected, mainly because of mid-year elections. They have the worst track record in terms of drawdowns, averaging 18%. And also because we have a wave situation, meaning the presidency and both houses of Congress are Republicans. Typically, we've lost 7 seats in the Senate, or 4 seats in the Senate, and 27 in the House, which would certainly be enough to make at least a split Congress, if not a totally Democratic one.
In that backdrop there, are there sectors that you guys are favoring for 2026, or factors that maybe do well in that kind of environment?
Well, right now, we're still sticking with our overweights on communications services, financials, and technology. I typically get the question at the beginning of each year, should I buy last year's winners or losers? And the answer really is, if last year was down, you buy last year's losers. If last year was up, you stick with the winners. And instead of getting a 10.5% return as you would have since 1990 for the market, you ended up with more like 13.5% for the three sectors and more than 17% for the 10 sub-industries.
So, Sam, one of the themes of this market, maybe the theme of this market for the last 2 to 3 years, has been AI. And I think maybe some of the discussion most recently has been, is there an AI bubble, at least in valuation out there? How do you think about that big theme of AI?
Well, certainly, I know that, when you look at a 20-year PE, you say, well, wait a minute, AI hasn't been around that long. So look at a 5-year PE, and we're trading at a 24% premium on the tech stocks to their last 5-year average forward PE ratio. But when you think about it, that does not compare with what we saw back in 2000. Tech stocks were trading at a multiple of 60 times forward estimates. Now, based on 25 estimates, estimates, it's closer to 30%, and it's below 20 when you look at 27 estimates. So we're still constructive on the longer term, even though we do think a digestion of recent gains would be quite healthy.